All right, so this is part 2 of the chapter 1 practice problems. Oops. So if you haven't looked at part 1 yet, after you watch this video, go and find part 1. All right, so we've got Melinda, and so she is investing $200,000 in a City of Heflin bond that pays 6% interest. Alternately, Melinda could have invested the $200,000 in a bond issued by SureThing Incorporation that pays 8% interest with similar risk and other non-tax characteristics to the City of Heflin bond. Assume Melinda's marginal tax rate is 25%. All right, so what do we have going on? So what we're going to do essentially is we're going to evaluate these two investment options. All right, and so she has $200,000 to invest, and she could invest in a City of Heflin bond or a corporate bond. All right, now, what is the cool thing that we know about City of Heflin bonds? Well, we know that City of Heflin bonds are what are called municipal bonds. And so municipal bonds are tax exempt. All right, and so if they are tax exempt, then they are not included in taxable income, and your stated rate, okay, which in this case, the stated rate is 6% interest. So this 6% interest is called either the stated rate or pre-tax yield, okay? So if they are a tax-exempt bond, then your pre-tax yield or your stated rate is equal to your after-tax rate, okay? And for us, since we are taxpayers, how we have to evaluate and compare investments is based on after-tax rates, okay? So based on all of that discussion, what is Melinda's after-tax rate on that City of Heflin bond? Well, we just said that it's a municipal bond, and so for a municipal bond, pre-tax rate equals after-tax rate, and we know that the pre-tax rate is 6% because we were told that. So therefore, the after-tax rate is also 6%. Okay, so that's kind of a cool fun fact regarding municipal bonds. All right. So now then our next question is, how much explicit tax does Melinda pay on the City of Heflin bond? Well, the first thing you have to know is, what the heck does explicit tax mean? Okay, so let's define explicit tax really quickly. So explicit tax is the amount of tax that you pay, and so it's typically based on a stated rate. And hold on, I gotta change my pen. I somehow managed to leave it in highlighter. So an example of an explicit tax would be income tax. Sales tax is an explicit tax. There's a stated rate. You know you're going to have to pay it. You know based on your tax base what your stated rate is going to be. So that is an explicit tax. The next question then asks us about implicit tax and how much implicit tax does she pay. Ooh, so hold on. I got to go back because I just realized I didn't really answer the question. We talked about what explicit taxes were, but we didn't answer the question. Okay, so let's calculate the amount of explicit tax. All right. So explicit tax. So what do we know her stated tax rate is? Well, her marginal tax rate is 25%. What is her explicit tax on the City of Heflin bond? All right. Well, her explicit tax is 0 because it's a tax exempt bond. All right. So her explicit tax equals $0. Okay. I apologize for defining explicit tax, but not answering that question. All right. So now back to implicit tax. Okay. So implicit tax is not based on a stated rate. All right. Implicit tax instead is essentially the amount that you lose or the difference in your the amount that you receive as a result of investing in a tax-advantaged investment. So it's, I can write that more simply than I was going to. So it's the cost related to a tax advantaged investment. All right. So it's the cost related to a tax advantaged investment. And I'm going to go on to say that it is very situational, meaning my implicit tax might be different than your implicit tax because it's very situational and not based on a stated rate. So you have to take all of your facts and circumstances into consideration. Okay. So now we have to figure out how much implicit tax does she pay on the City of Heflin bond. Okay. So let's come over here and I'm going to change colors. Implicit tax on City of Heflin bond. Okay. So what does she invest? She invests $200,000. Okay. And her rate of return on that city bond, based on the information in the problem, is 6%. So her interest income is $200,000 times 6%. So her interest income is $12,000. Okay. Now, if instead she were to invest in the Sure Thing Incorporated bond, the corporate bond. So if she invests in the corporate bond. Still a $200,000 investment, but now the problem says she will pay 8%, or she'll get 8%, excuse me. It's an 8% yield. That is going to be $16,000. Okay? And so her implicit tax is the difference between what she would get from a rate of return perspective for the corporate bond versus what she'll get from a rate of return perspective from the city bond. Okay? So her implicit tax is $16,000 minus $12,000. So her implicit tax is $4,000. Okay? Now, how much explicit tax would she have paid on the Sure Thing Incorporated bond? Okay? So let's figure that out. All right? So we're going to come down here. Okay, and we'll figure out her explicit tax on the Sure Thing corporate bond. Okay, so first off, what do we know? We know that she invests $200,000, and we know that her pre-tax rate of return is 8%. So her pre-tax earnings, her pre-tax interest, is her pre-tax interest income. Okay? But we also know her marginal tax rate is 25%. And we need to know her explicit tax. So her tax is equal to tax base times tax rate. Okay? And so her tax base is the $16,000 of interest income. Her tax rate is her marginal tax rate of 25%. And so her explicit tax on that Sure Thing corporate bond is $4,000. All right, and is that the last question? Ooh, no, it is not the last question, because now we have to answer this last question, which says, what is her after-tax rate of return on that Sure Thing Incorporated bond? Okay, so how we're going to do that, and there are a variety of ways to do that, but there is a formula that is just a fantastic formula, and you will use it throughout the semester, and it is my favorite tax formula ever, and you should absolutely memorize this. So it's after tax equals pre-tax times 1 minus the tax rate. Okay? So, what do we need to know? Well, we need to know our after-tax rate of return. Okay? So that's right there. Do we know the pre-tax rate of return? Well, sure we do, because we know that she had an 8% interest rate. So that's our 8% yield. That's always given to us pre-tax. So that's 8%. And then 1 minus her tax rate, not the interest rate, not the yield, but the tax rate. And so her marginal tax rate is 25%. Okay? So remember to pay attention to your decimals, okay? Because decimals can really trip you up with percents. All right, so now we've got after tax equals 0.08 times 0.75. And so after tax equals 0.06, which means her after tax rate of return is 6%. Okay? So if she were going to choose between the City of Heflin bond and this Sure Thing corporate bond, their after-tax rates of return are the same, okay? So she would have to choose an investment either by flipping a coin, or chances are one of these investments has some other characteristic that's significant enough that would cause her to choose one over the other. But from a strict after-tax rate of return perspective, they are equivalent. All right? All right, so this is the end of Chapter 1, Practice Problems, Part 2.